Well, good morning, everybody, and welcome to today's AMIC Academy, Myth Busting, How Trade Credit Continues to Help Clients. For those who don't recognise my voice, my name's Patrick. I'm the principal of the Academy and a fellow corporate risk and insurance manager. My job is to facilitate what I promise is to be an excellent presentation. Now, AMIC actively promotes and supports the planning, undertaking and subsequent recording of CPD, continuous professional development. So please don't forget to claim one CPD hour for today's webinar. Now, today's session is brought to us by Richard and Rob from Willis Towers Watson, one of our valued partners. And I'm sure everybody's familiar with Willis Towers Watson. So you'll know that they're a leading global advisory insurance broker and risk solutions company with 45,000 employees serving more than 140 countries and markets. Now, today we're going to focus on trade credit, and it's played a crucial role in keeping organisations afloat during the pandemic. And it feels to me very timely to look at this topic, either for the first time or as a refresher and update. And today's webinar will last an hour, and it will cover the assessment of trade credit risk, an overview of the trade credit insurance product and insurers' appetite, so what the market is doing right now, the key role trade credit insurance has played and continues to play in maintaining supply chains through the COVID pandemic, and how insurers may deal with the expected high and increasing rates of bankruptcy as government support during the pandemic ends. So we'll get to a final point at 11 o'clock, and by this time we should understand how an organisation uses credit insurance to maintain cash flow, stay competitive, expand into new markets, and help to collect invoices and understand the financial position of our organisation's clients. So that's the warm up on the session. Just on logistics, we will turn over to Q&A at about 1/4 the hour. You'll see on your go-to webinar control panel, there is a tab saying questions. That's where you should pose them. And I will curate those at about 11:15 and turn over, and on your behalf, we'll have the Q&A session. Today's session and the slides, so the session is going to be recorded, and the slides will be socialized after the event, so that may influence the way you listen and take notes. And just as a heads up, when we finish at 11, as we terminate the session, there's a quick questionnaire, literally 20 seconds. It would be really appreciated if you could just take that time to give feedback to our presenters, and of course your feedback very useful to AMIC in our learning and development planning. So to our presenters today, you can see them there. We have Richard Tallboys. Now Richard is head of trade credit GB, and he's worked in credit insurance for 43 years, first with the UK Export Credit Agency and then as a broker before joining Willis Towers Watson in 1987. Now, Richard has worked with a wide array of sectors, including media, travel, commodities, the motor trade, energy, and agrochemical and food and drink, so a vast experience. He's an associate of the UK Chartered Institute of Credit Management and a member of the FCIB, which is the international arm of the National Association of Credit Management. So Richard is joined by Rob Bolton, who's an executive director at WTW. He started in credit insurance back in 2006, gaining experience in the UK domestic market and then focusing on large multinational clients. Rob's currently responsible for managing a portfolio of global clients with a variety of insurers, so that's interesting, across a wide range of sectors, such as paper manufacturing, motor manufacturing, motor distribution and retail. And he has market experience in placing both excess of loss and whole turnover policies. So welcome to Richard, and Rob, over to you.
Great, great, thanks Patrick. So just to sort of reiterate what Patrick gave in his brief overview, here is the agenda, and this is essentially what Richard and I will be discussing over the course of the next 45 minutes or so. Essentially to provide an insight into what trade credit insurance is, what it is not, importantly, as technical terms, and their application can be misleading or confusing, and there are many grey areas. Where we are currently with the COVID pandemic in mind, and ultimately to dispel any myths or misconceptions there may be about the trade credit product, hopefully through the content of this presentation, or if there are any queries in the Q&A afterwards. We also have a case study explaining how one of our clients uses the product, and a view from one leading insurer with an insight into their underwriting criteria at the end. However, depending upon time, as Patrick mentioned, this may be available post the presentation. So now Richard will start with the myths.
Thanks, Rob. Good morning, everybody. Although very different to the 2008 credit crisis, insurers have reacted very differently. We still hear quite a lot of misconception about the product and what it actually is. So we're trying to unlock some of those myths. We still frequently see comments like they remove cover when you need it most, they get cold feet and run for the hills when most needed. What's the use of an umbrella if it's removed when it rains? Fairly common, whether it's in the media or in our industry. It's understandable from the viewpoint of normal property casualty insurance taken out by a client on your own assets and risks. But we need to be aware a trade credit insurer has an insurance contract with a duty of care to help manage non-payment risk for the seller of goods and services to third-party companies that they've got no control over, and doesn't directly act for that third-party customer, i.e. the risk. Doesn't ever remove cover retrospectively. That's a common misconception. That would be deeply unfair, to be honest. Just for future sales in a negotiated basis, and there can even be long delayed effect periods in order to manage exits so as to allow renegotiation of contracts. That's particularly pertinent now with the government reinsurance dropping away. So primarily, it's a proactive credit risk management tool first, allied to the credit and financial risk management discipline within a company or a financial institution. It's not, unfortunately, it's not a lender, or fortunately really, a lender to distressed business, as Rob will explain a bit more. Next slide, please.
Okay, so what is trade credit insurance? So the core insurance product covers non-payment due to insolvency, which is fairly straightforward, but also protracted default, which is non-payment over a specific period of time, even though the buyer still remains operational. And also blanket political risks, almost as a beneficial add-on for export trade. It is not insurance of predictable or already distressed risk, as Richard mentioned, and if customer default probability is too high, insurers can cut cover as part of proactive risk management. And this particular aspect of the product is often misunderstood and is largely responsible for the majority of the product's bad press, as Richard mentioned. One of the reasons businesses buy trade credit insurance is for the third-party vetting and monitoring of risk, as well as information sharing that an insurer brings to the relationship. And I'll expand upon purchasing motivations shortly. But in the meantime, Richard will explain the insured contractual relationships and the cash flow cycle on the next slide.
Sorry, lost my mute button. As we mentioned earlier, the parties to a credit insurance contract are really the seller and the insurer, not the risk that they're insuring. So remember, those are the parties to the contract. The buyer, the customer, the risk, who often is the one quoted in the press as saying credit insurance pulled my cover, is not party to that insurance contract. Many of those big buyers do have regular communications with insurers, although normally it's a confidential placement. And those insurers will be writing large amounts of what is effectively support for unsecured lending, and thus the supply chain. Disclosure of the current financial situation is actually imperative. If it's not publicly available, then there needs to be some means to provide financial information. No financials, no cover. And we do have issues with privately owned companies sometimes, and even private equity. Think bank lending and what information a lender would want to see before lending money, because it is unsecured credit. Trade credit is unsecured trade credit generally. And what the financial situation in that information shows is that the business position, shows the business position up to 18 months ago. So if you get a set of annual report and accounts for 31st of December, it reflects the position the previous year, and you're then extrapolating forward, trying to assess a risk based on historical information. So a lot of current information is necessary, and the more we've seen through COVID is real-time information is absolutely essential. I guess you can compare it to a building that maybe have last surveyed 2 years ago. Smoke might have been seen coming from one wing, or worse, a surveyor was not even allowed in. It's difficult to assess. This is where the headlines come from: credit insurers cutting my cover. But remember, the duty of care is to the insured, the seller, to manage and help them manage the risk of non-payment from that third party, not as a lender to that third party. Moving on to the next slide, please. The cash flow cycle is, I'm not going to get into the technical issues here, but the cash flow cycle in a very simplistic form is as just shown here. If you go around the cycle, pretty much every stage in that process, the business is insured, such as business interruption, marine cargo, asset protection, fire insurance, property casualty. And all too often uninsured risk is the debtor asset at the top there. Cash due to be received, invoices to be paid. And often in companies, perhaps companies who haven't got manufacturing plant, they're buying and selling, they're trading, that can be the largest item in the balance sheet and represents a risk outside the control of the company that insurance should really be looked at the very least. The perception of that risk, my customer I've known for 30 years, I play golf with him every day, the perception of that risk is very subjective and becomes a discretionary spend. You can have two companies with almost identical profiles and similar customers, one insures, one doesn't. But insuring it will complete that cycle, as the trade credit insurance can provide indemnification in the event of non-payment by the customer, and it allows the cycle to complete. So this is what trade credit insurance is. And now a reminder quickly of what it isn't. That's next slide, please. Slightly negative, but it gets mixed up. We get asked almost daily, can you provide credit insurance on this, that, and the other? So just a reminder, it's a B2B, it's a business-to-business trade credit from business seller to business buyer. We're covering corporate insolvency risk. We're covering contractual amounts due for payment, but we're not covering consequential losses due to insolvency of a third party. We can't include B2C retail sales to Joe Public. Financial guarantees or simple loan default. You know, my bank will lend me 100 million quid if you can get an insurance on me. No, sorry, I can't do that. Unfortunately, we can't include commodity price movement, market risks, exchange rate movements, hedging, pure financial tools, although we can cover a little bit of mark-to-market risk in some coverages. BI, consequential loss of profit triggered by a third-party bankruptcy, is a common request from our corporate P&C colleagues, because that's excluded from most business interruption coverage. That's not, I'm afraid. I know Zurich tried to do it, but at the moment, I don't believe there's a product there for that. Because again, we're covering contractual amounts due rather than a consequential loss of revenue or profit. And we frequently get asked about speculative new investment risk or future income flow, whether it's rental, property, solar power revenue, electricity, or similar guarantees to support an investment. I'm sorry, that's not really possible to do. So reminder, trade credit is B2B in the normal course of trade, not in exceptional cases. So Rob will talk a little bit now about why companies use trade credit insurance.
Thanks, Richard. Okay, so why companies buy credit insurance? So businesses buy trade credit insurance for a broad range of reasons, and we'll discuss a few right now. So increased sales by enabling unsecured trade terms in order to be essentially more competitive, and in effect moving from costly secured terms such as letters of credit, bonds or guarantees which tie up working capital for the buyer to unsecured open account terms. And the general range of open account terms within our market varies from 30 up to maybe 180 days, depending upon the sector and importantly the fundamental product. thinking of the cash flow cycle that Richard just described. Expansion into new markets and growth with the risk mitigation that a credit policy provides, as well as the financial insights that the underwriters can offer on a business's new customers. This can also be expanded into macro country risk analysis. Many underwriters have the financial analysis, but also the country risk analysis departments as well. Protect cash flows, excuse me, by identifying any insured losses, effectively replacing lost cash from unpaid invoices. Enhance borrowing ability and reduce borrowing costs with the reassurance a financial partner or lender will get from the protection and rating an insurer brings. And this effectively replaces the financial rating of the debtors to that of the insurer, and it can also enhance capital relief for the lender, so a multi-pronged benefit. Balance sheet protection by safeguarding generally the biggest unsecured asset of a company, its receivables or unpaid invoices. Protection against political risks, generally export related when trading in emerging markets, as mentioned previously. Replacing letters of credit as part of a sales and growth initiative. Releasing or capping bad debt reserves on the balance sheet with the implementation of a policy, so a treasury and accounting benefit. The product can be used to reinsure and support best practice credit management procedures. And one of the least appreciated aspects of the product is the real-time and cost-effective credit information source that the underwriters can provide. So you'll see there are multiple benefits to different parts of a business. And our partner audience can be treasury, risk management, and in some cases sales, or even a combination of stakeholders. Okay, next slide, please. So who are the main trade credit insurers? So as you'll see from the slide, trade credit is a niche product and the insurance market is narrow. And it's really dominated by a few monolines who focus specifically on credit, one MGA, and a few specialist divisions of multinational carriers. Each underwriter has their own USP across the spectrum of the product, as well as working knowledge of specific industries. Barriers to entry are high, hence the monoline trade credit insurers hold the market share of global premiums and policies, as they are able to monitor and analyze millions of risks around the world through their risk underwriting offices and platforms. Next slide, please. And now on to COVID. So this slide tries to give a sort of almost a chronology of the impact of COVID. And the most obvious impact of COVID was lockdown and the forced closure of businesses, which impacted supplies across all industries, as well as cash flow for many companies. The government mandated shutdowns reduced trade flows in many sectors, and therefore actual limit needs, exposure and requirements had been very low. It also had the effect of freezing various markets, and ours was one of those, as insurers battened down the hatches and awaited the well-reported tsunami of claims. Insurers had already been reviewing the portfolios prior to COVID, following several large-scale insolvencies and with an expected downturn on the horizon, and so had already entered into extensive dialogue with policyholders about exposure and buyer limit requirements. Many supply chains started creaking as sellers chased payments and buyers tried to manage their dwindling cash flows to their own best advantage. Insurers at this point took a more relaxed view to payment extensions, ultimately as if they did not, then they would crystallize losses, forcing businesses into insolvency as opposed to trying to manage extended payment terms. Insurers publicly announced that they were not open for new business, as new-to-market business cases spiraled, as well as queries on limit shortfalls on existing insured business. As the lockdowns progressed and economies nosedived, the supply chain issue was exacerbated, as was the lack of or the inability of consumers to spend cash in many forms, bringing the global economy into contraction. During this time, many insurers and brokers had been lobbying governments around the world to recognise the importance of supply chains and the need to support them. Some governments listened and various unaligned government reinsurance schemes were put in place, some of which, like the UK scheme, came to an end on the 30th of June. Next slide, please.
Thank you. Thanks, Rob. Yeah, I mean, that government reinsurance was really important in maintaining coverage and maintaining coverage so that the supply chains could be maintained and suppliers and customers still continue to trade during COVID and keep businesses alive. In terms of the impact on the insurance market, during 2020, the renewal cycles we saw, premium increases were marginal because a lot of those losses hadn't actually occurred. It was an anticipation of losses. So there was a fear of that tsunami, which is still there. We saw rate increases between 5 and 15%, based more on that perception of risk than actual claims paid. Given the level of government support across Europe, not just for the reinsurance support for the industry, but the various business loans and furlough schemes that were put in place by many governments to support industry and keep companies alive when their customers weren't buying anything. In any event, there was a pre-COVID, there was an essential readjustment of pricing, as Rob mentioned, because that was deemed required as the market had become too soft, given the level of risk out there, part of this cycle of risk. Moving into 2021, of course, we then had more lockdowns, I think, third stage? That forced many businesses to close again or remain closed, and delays in exiting lockdown were still hindering growth. Monday into Freedom Day comes up soon. Although losses have occurred and claims are being paid, there's a lot of companies out there who are surviving on government support or delayed payment terms from their suppliers and might struggle once these are removed. This is what our insurers are fearing, that there will still be a big crash. So during 2020, as Rob said, many governments supported credit insurers to maintain the flow of credit in the supply chains. But now many of these European government reinsurance schemes are due to end, or were due to end at the end of June, so have ended. Thankfully, with full communication with insured and customers, the insurers are maintaining a lot of that cover that was previously supported by government, quite a surprising amount actually. And supply chains generally remain supported, but not all. There are some businesses out there that are deemed too high a risk without the government support for a commercial insurer to maintain. And those will be companies that would have been struggling before COVID, and then it's difficult to see a way forward now, even post-COVID, as we come out of recession. Even good trade financing, supply chain payables, receivable purchases, and securitizations and such like, those remain insurable. In fact, that's where we've seen most demand as companies seek additional financing and banks look to lay off some of that corporate risk. Despite the news and noise in the media about Greensill, Gupta, and David Cameron, that is really an outlier. It's had a concern, but not an impact. So recognizing the media attention around this, if anyone is interested in this specific subject, we can take it offline later, but it's very much a one-off event, we believe, so that the market is damaged, but not closed. So in conclusion, remarkably, the industry has thus far avoided major failures. It's very open for good business with good fundamentals and history in appropriate sectors, as Rob will explain more in the next slide.
Yeah, thanks, Richard. Yeah, so essentially insurers are open for new business. However, they do remain selective in their approach to new submissions, with reduced risk appetite in impacted sectors, which I'm sure is no surprise. However, as economic activity begins to start up and vaccine rollouts expand, they have all shown stronger appetites for new risks, though based on strong fundamentals, as Richard mentioned, with a deeper level of current information required prior to indicating terms. But what this means in practice is that underwriters will need up-to-date financials and management accounts as a minimum before being able to indicate on a buyer risk. And as Richard mentioned previously, I guess underwriters were often looking at historic financials, often a year out of date, fundamentally from the financial audited accounts. So up-to-date management information is generally a key. And as Richard said, claims are being paid, although the expected tsunami of losses is yet to be seen or may not even materialize. And the target sectors for new business and growth are unsurprisingly those sectors which have largely benefited from lockdown. And you'll see on the slide, these are broad sector tags, but chemicals, pharmaceuticals, electronics, to name a few. But you would not be surprised to hear that retail, aviation, and travel are not really currently readily insurable, as are all viewed as highly vulnerable. And Richard will now talk you through a brief case study.
Next slide, please. Oh, sorry, no, next one, that's the right one. We've got to be very careful here, and this is a very anonymous case study, so if we did too much detail, it would be too much. The client is a luxury goods manufacturer, let's say, synonymous with quality and style. This company relies entirely on a credit insurance program which supports its trade financing, which finances the dealers and distributors of the product. They're non-owned around the world, so it's a global program. And the working capital facility is entirely supported by a trade credit insurance program. And without the trade credit insurance, there's no working capital which provides the financing for their dealers and distributors. Clearly, during lockdown, a lot of these companies shut down and closed down. We were able to adapt and enhance the insurance policy to ensure it continued to meet the financier's needs, but more importantly, and reduce the cost of borrowing. But more importantly, maintain the coverage, which meant constant dialogue. I think we were doing weekly or bi-weekly calls, going around the dealer network, making sure that the dealers and distributors of this product were open and transparent with whether they were open, whether they were shut, whether they got local financing, local support, whether there was any sales going through at all, and trying to make sure there was visibility, transparency, and a future. Look, they got the working capital themselves, individual dealers, to survive. And in order to maintain the coverage, the insurers were extraordinarily supportive, maintained a lot of coverage there, even while these dealers and distributors were closed down, pending a reopening. And we've been able to maintain cover, and as products begin to flow through again, coverage is there and back in full force. So it's been an excellent experience. It's quite a generic situation. We can give a lot more detail, but that will give away too much, I'm afraid. But the key is that there was a real support for the business during COVID, and it's a good story. Now, let's have a look at how an insurer actually assesses the credit risk. Next slide, please, Matt. We've borrowed some slides from one of our key insurers, Markel, who specialize in trade credit, or Markel obviously do other things too, but their trade credit team specializes in some niche trade credit products in excess of loss, working in partnership with sophisticated credit risk managed businesses to provide balance sheet protection and support for working capital. So they're used to working with good partnership. Their own corporate slide here, their own philosophy, sets out their modus. It's not simply a risk review of the counterparty. They take into account a range of factors there. I mean, their own corporate underwriting approach, the risk in the context of the policy wording, and that's important to note, that's related to the structure and policy, not just the wording. It's the levels of deductible and retention, because the bigger level of retention, the better partnership and risk sharing means interests are much more aligned, and coverage can be underwritten, which might not be underwritten on a standalone basis. They're looking to leverage existing knowledge and communication, as we mentioned in the case study, that those clients they insure have good relationships with their customers and are able to share information. That's absolutely critical. They also look very closely at the economic sector and market awareness, which is really vital, as Rob alluded to earlier. Some of the sectors now are in deep distress. We've been heavily involved in the aviation and travel sector for the last few years, and that has obviously been something of a crisis for the last 15, 18 months. So they will look very closely, and then they start to look at the actual buyer analysis, the risk analysis, that third-party buyer we alluded to earlier. So if we look at the next slide. So what are the risk factors? And forgive me, I've got my wrong glasses here. Looking at the slide here, you can see that quite a number of businesses fail in the early part of their lifespan. 50% of all businesses don't exist after 5 years. Now, it doesn't necessarily mean they've gone bust. It means they've been purchased, sold, merged, closed down, failed. 33% of businesses make it past their 10th anniversary. So once you get past there, then you've got a pretty good chance of surviving for much longer. Then the experience of Markel, their historical loss data suggests losses are likely to occur with the smaller or mid-sized companies, and that's why we tend to focus our concern. The very large companies, you tend to see incidents happening. They tend to be very public cases with one or two privately owned exceptions. So it's at its worst with entities with balance sheets below $100 million. So if a sector or economy deteriorates, these businesses might not be able to refinance, and that's key. It's the support from the banks, from the lenders is really important. It's important for support in a recession. It's also even more important as we come out, because we've traditionally seen more failures occur as you come out of a recession, as companies try to gear up to cope with expanding growth. Next slide, please, Matt. I'm talking to the slide slightly here. Why do businesses fail? You could have legal cases, litigation. There's been one significant failure we had encountered recently, which was a direct result of a legal action which triggered a bankruptcy, because they lost. The high leverage is a particular, I personally say almost a poisonous problem. Far too much debt, and if you hit a downturn, then trying to refinance that debt has been a problem. We've seen that in sectors like the Texas oil patch, for example, companies trying to refinance when the oil price was crashing, and they'd borrowed heavily to cope with the growth, and then the cycle turns very quickly, and you're left with a huge lump of debt. So an awful lot of, in the States, Chapter 11 allowing refinancing to happen. Companies can grow too quickly, can outgrow their systems and their strength, and we've seen that happen too often with new products, that the systems, procedures to manage a business efficiently haven't been put in place, and companies have just grown too quickly. So too much sale but not enough cash collection. A sector deterioration. This is a key problem we've seen pre-pandemic, when we were all watching changes in buying patterns, and that's been a fundamental issue. Obviously, those of you in the retail sector will know that very well. That as we all buy from Amazon or online during COVID has exacerbated that. So those changing consumer habits has made a real problem, and there will be accelerated changes, and the bricks and mortar retailers may not be a feature of business in the future. Companies with a concentration risk. If you have one particular customer and that customer becomes a problem or goes bad, then you can be knocked over too. But one of the key fundamentals that the insurers focus on is cash flow management. And if you're not managing your cash and getting your collections in, then absolutely vital and a real indicator of problems. So looking to the next slide, I'm not a credit analyst, I'm a broker, so I'm not going to go into too much detail here, but the way it's pictured is that the insurers will look first at that cash flow statement, then the balance sheet, and then the P&L. It's interesting to note that profit is not necessarily a guide to good health, strength, or risk. You can have a profitable company, as they say here. It doesn't actually translate if the poor cash collection, but on the face of it, you're making a profit, but you're not getting a cash in. Companies can fail. Looking at the next slide, balance sheet, debt, that comes next. What's the trajectory? Companies, start again. The debt structure comes next. The company can be paying suppliers on time, but fail due to an inability to refinance, say, a bond or a lending facility. So the insurers will look at that trajectory of debt. When's it due? When does it come up for maturity? And we've seen this many times recently, where they see a big bond payment coming up, perfectly profitable in trading situation company, but with a large debt repayment coming up, which that business is clearly unable to support. So it's coming up against a hard deadline. So coverage gets monitored very carefully in those situations. You might have unutilized elements and look at available facilities. So that's good. That gives a cushion. So looking at the split of long and short-term debt, the cost of it, and more importantly, we see quite a lot of covenant breaches, which will trigger perhaps a bank taking action, or it's warranting a receiver even. Interest rates, gearing ratios are set out there. It's all reflective of the cash flow movements. Those are the fundamentals. We've gone a little quicker than I'd expected. So Rob, do you want to close the presentation, invite some questions and answers? But we're happy to take questions and elaborate on these a little more.
Yeah, thanks, Richard. So that is our whistle-stop tour of the trade credit product and the current market environment. I appreciate, as Richard said, that we are sort of almost 10 minutes early, but hopefully we'll still get the full hour of CPD. I'm sure there'll be questions or queries. I hope there will be. Trade credit insurance is a very different product to most general insurance lines. It deals with a third-party risk that is not necessarily visible in real time, is not within the insured's control, is subject to a number of external influences such as interest rates, inflation, trade wars, tariffs, dramatic changes to buying patterns, new technology, not to mention sudden catastrophic shocks, such as the one we are now hopefully coming out of. If there are any questions at all, please do let us know, either now in the chat box through the mediators, or do contact us directly.
Perfect, Rob. Thanks. Well, we've got some questions, so let's get cracking on them. So, firstly, an observation. Thanks for the content on the slides. I think, you know, as we reflect on trade credit going forward as individuals in the context of our organisations, I think the slide deck will be a very, very useful and insightful resource. I think the other observation at this stage is actually you have very much a sort of risk first, insurance second kind of approach to this. And I think as buyers of insurance or managers of risk, that's very much the approach we'd always advocate. That it's very difficult to know whether your insurance is fit for purpose if you don't truly, number one, understand the risk and actually understand how insurers view risk in this particular area. So on to questions. I have one, the first one has come in. Could a buyer purchase trade credit for the benefit of the sellers they purchase from, or is it the seller's responsibility? How does that sort of alignment liaison work?
Well, the buyer obviously can't technically buy insurance on themselves. That becomes a financial guarantee and is excluded from all the reinsurance treaties. But we have got many cases where a buyer has established that there is coverage on them available in the market and has helped arrange for the seller to take out a policy and the buyer has paid the premium. So we've done it that way around. And you're getting into a lot of the supply chain financing area there as well, where an intermediary actually buys the policy and arranges extending the finance one way and taking the risk the other way. And that's where the green seal problems came up, that it's not necessarily a bad play if the parties are good.
Yeah, so obviously the relationship between the purchaser and seller of the goods or service is absolutely key, because you have one party who's buying it, but actually it's the information contained in the other party that's key to the underwriting. So that's a really interesting dimension.
Yeah, you see it quite a lot where, for example, a seller is insisting on collateral or secured terms or a guarantee from the buyer, and the buyer's saying, well, actually that cost me money to put up that guarantee or that bank guarantee or to pay you cash or short terms. You know, can I get a longer credit if I can help arrange for you to get a credit insurance product on us? And we can do single risk. Generally it's done on a portfolio basis, but there is a market for good single risk if the reason for the selection is clear. If it's not an adverse selection, just trying to dump the worst risk, that doesn't work.
And that comes down to the sort of the good fundamentals that you know, we mentioned previously in the slide. So that story around the why, essentially, and you know, the financial backdrop is key.
Great. And just elaborating on the topic of relationships, can you talk a little bit more about the relationship between insurance and insurers and the bankers, lenders and loans involved in the money flow? How does that interact?
Okay, that's a big question. I guess you have to go back a bit. There's actually two different types of credit insurance. There's the more traditional ones issued by those monolines, the Coface, the Euler Hermes, and the Atradius, where to a certain extent in the mid-market and smaller end, those sellers actually outsource to the insurer the credit management assessment, that risk management you talked about earlier. And that's only when you get into the bigger, medium-sized companies and bigger that there's usually a much better competence in credit assessment and credit risk management. And the insurers then, you evolve into the excess of loss insurers who work in partnership with that kind of seller. And so those partnerships tend to be very close, very intimate, and an awful lot of discretion and trust because there's a big risk share in there. The more traditional program, you still build partnership, but there's a huge reliance on the insurer to monitor the risk carefully and on the insured to actually obviously act as a prudent uninsured, that's the basic, but also to help obtain financial data and information. Getting into the financial institution, there's a whole range of different financial supports in the generic sort of supply chain. You've got receivable financing, which is probably the main side of this, often factoring, simple factoring. A bank or factor can take out their own policy if they're buying receivables on a non-recourse basis because they own the insurable interest, but they have to stay in partnership with the vendor or the seller because they act as agent in the collection because it's their expertise and their invoicing and their customers. You'll often have, across many credit insurance policies, have a loss payee, which will be something like a factor or receivable finance company, because that means the vendor continues to run the policy and just assigns the benefits to the bank. A lot of financial institutions will buy anonymously. They'll buy a book of receivables and they'll take out coverage themselves independently and keep that remote from the vendor, who effectively is an undisclosed agent. So there's a huge range. And then you can do the more exotic supply chain financing, which is almost reverse credit, as we touched on earlier.
Fascinating. So, well, thank you for that information. Now, I fully expected this to come up, this next question, the very nature of the EMIC membership and our audience today, and it relates to captives. So do you see much captive participation in trade credit type structures?
Yeah.
Are insurers, reinsurers really welcoming of this, or do they find it inconvenient? And, you know, supporting the premise of financing the risk first and then seeking insurance market support only as and when it's needed in relation to the sort of buyer's, you know, own inherent risk appetite.
On the latter point, that's more difficult to do if you're doing effectively an adverse selection by just trying to retain everything in-house through a captive and then just insure the high-risk customers. That's more problematic. The whole credit insurance business is generally done on a portfolio, but the concept of spread of risk is really, really important. But the captives, yes, there are many captive structures there and can be done in a number of different ways. It might just be if you've got a good credit program which hasn't got a history of losses, so it's profitable to the insurers, then simply by bringing the captive in as a potential reinsurer for that credit insurer can help reduce the external premium spend, keep a lot more premium in-house. We've got captive programs where the captive actually issues the fronting policy, but obviously you've then got licensing issues locally, so that tends to be less frequent, more likely with captive as reinsurer. It's a heck of a good way to help finance a big deductible on a program. In excess of loss trade credit insurance, captives are used an awful lot. Trying to cover the higher risk territories, it is possible to obviously to bring in business that can't actually be insured elsewhere, but that obviously you've got to finance that carefully because you won't get the reinsurance on that.
I would say a large portion of our client base has some sort of captive involvement. Obviously structure and underwriter dependent, but yeah, whether it's, you know, primary insurer, reinsurer, whatever it might be. So yeah, we're quite used to working with captives.
Or acting for the captive manager. In many cases, we're the reinsurance broker for the captive rather than directly for the corporate. So we've played on that side of it. And obviously we're others I'm sure are familiar with producing the necessary bordereaux and managing, and in a number of cases we were actually actively assessing claims within the captive layer and had delegated authority from the reinsurer to approve claims, which was quite a rare piece or a rare place rather for a credit insurance broker.
Right. When you referenced a case study earlier, and I'm very conscious that when we say in this modern age, you know, something's an outlier, it's a black swan, and we do that halfway through a pandemic, which was, you know, possibly not expected by many. So you made mention of Greensill, and although you've clarified that it's an outlier, are there any sort of key review points or lessons learned or mistakes made that you draw out so that our audience today can, you know, really learn from that, albeit it may have been an outlier?
Yeah, I need to be a bit careful there because obviously I've met Lex once in the past, but I didn't act for him, thankfully. I think one of the things I've seen with it is where a business has a complete dependence on credit insurance and has astonishing growth targets, which required unbelievable amounts of credit insurance capacity, which to my mind seemed unrealistic. But whether that's visible or not to outsiders is difficult to say. The due diligence conducted by the financiers could be a challenge or could be challenged. Interesting to note that the insurers of this one were, as often reported in the press, a small shop in Australia, above a shop, I think, in Australia, a little partnership sold to Tokyo Marine, which is interesting in and of itself. It was writing huge amounts of capacity, but again, that's not necessarily visible. I think due diligence is probably the big lesson. Conduct your due diligence, ask questions, dig. This one has, there are so many different factors that have come into the Greensill if you read the press and follow some of the blogs on it. Because a lot of what was allegedly insured with Liberty Steel, for example, and again, I have to be careful, I'm not alluding to anything, but there's an awful lot of what doesn't look like true receivables. If you read the press and read between the lines. The trade credit insurance covers receivables, goods sold and delivered, invoices raised for goods sold and delivered. It doesn't cover future income flow. And it's quite interesting to wonder whether the particular credit insurance policy was written rather too extensively. But generally, a credit insurer won't cover a future income flow that has not been invoiced. They cover contractually enforceable debt. And one has to question whether what was being financed in those particular cases was contractually enforceable debt or unsecured lending, basically, against the anticipation of future revenue. But again, I don't know who would have visibility of that in real time at the time. I'm not sure we can draw lessons from the market. I guess I have to say, as that situation evolved in pre-COVID, most insurers have come across this business and had rejected it. So, but we know that from the inside, and had refused cover or lapsed cover.
I think also more broadly, I think, you know, the market, you know, underwriters and brokers are very skeptical and wary of businesses that their business models depend upon credit insurance for their business to work effectively. If there's no credit insurance, then there is no model, and I think that is a sort of a big warning sign.
That was very much seen with this particular business. I mean, if you again read the press, there was 6 months notice of non-renewal of that policy. It wasn't it wasn't the sort of headline you see where credit insurers cut my cover and I've been left unsupported by my suppliers. They had a 6 months notice that this was a problem, and they'd already burned most of the market. Because if you look at most of the failures, or the, should we say, slightly tainted failures over the last couple of years, there was as we understand it, an involvement there. NMC Healthcare was the big one, which is a massive loss to the insurance market. I've got to be a little sensitive because these things are still going on.
Sure. Well, we appreciate your openness, and you know, Chatham House rules tend to apply to EMIC Academy, so you're in safe hands.
Thank you. Yeah. Although you can delete the recording of that bit.
Absolutely. Yeah. Well, yeah. We'll take that bit out. Don't worry.
Yeah.
Just we've got a few points and questions really that sort of interrelate, and it's really around the efficacy of the insurance, the trade credit insurance, proposition. And you touched upon the appetite of insurers. So can you just talk to what other options are available to buyers beyond proactive engagement and the sharing of information, if actually in reality insurers are actively avoiding certain sectors and types of business? Now that links, I guess, to a point that's been raised around, really, because of all you've said, things, other mechanisms like letters of credit guarantees, compared to trade credit insurance. So we're really talking about how can the risk manager sort of navigate around, the problems with insurer appetite, given that it's still got a risk that it wants to mitigate in some way.
It's probably not even a question for the risk manager. That starts to get reversed back down the chain, as it were, towards the commercial and sales department. If companies are selling into trade sectors that are inherently higher risk, trade credit insurance is just one of the options when they're looking at contracts and how to secure payment. So trade credit insurance is obviously a viable option. But in, as we said, cases in some sectors that's not available to an acceptable price at the moment, but the risk is still there and still very high. Then it becomes a commercial discussion with the customer as to how to effectively collateralize the payment. And your standard credit risk manager view, if they can't get insurance or insurance is cut or a customer slips on their payment, is to switch from unsecured credit to cash in advance terms. That's the very simple response, conversations we have on everyday basis. If a customer is particularly difficult, won't reveal financials, or is slipping on payments, then you don't offer unsecured credit. You offer, we will trade, continue to trade, but we'll trade on secure terms. And it may be, as I said, cash in advance, or you can move to the sort of security you mentioned. So a lot of export trade, for example, is secured by letter of credit. And you're covering then, we can still insure some of that if it's unconfirmed letter of credit, because you're covering the country risk, the currency transfer risk. If a letter of credit is opened in Pakistan, you're still covering the externalization of the funds or the blockage of that. And a lot of other trade is done on a collateralized basis where other securities put in. You might say our customer is a small subsidiary newly established, but the parent company is rock solid. So let's see if we can get a parent company guarantee. So you're getting into the whole realms of commercial negotiation on contract by contract basis.
I mean, one of the sort of conflicts there, of course, is that mitigating the risk in that way almost exacerbates the issue, because for the supplier, it causes a run on cash, and that
yeah, I mean, we mentioned earlier in the presentation, actually, in terms of the sort of almost the motivations for buying, credit insurance, and one of those is moving away from secure terms because it is a cash drain, or it ties up working capital for the buyer.
Yeah. But that's in the good sectors at the moment. If you've got a situation where you have a company that's, shall we say, in a terminal decline in a retail sector, then yes, there will be, that's a credit management decision. The insurers will echo that credit management decision, or that credit manager will look at that risk and think, well, actually, I don't want to lend unsecured to this business because its default probability is too high. And therefore, I want to get collateral.
Yes,
but yeah, it can accelerate it. You're absolutely right.
Yeah, so if an insurer is not keen on a risk, we should be asking ourselves the question: should we be keen on doing business fundamentally?
Yeah, fundamentally,
because everybody should be looking at the risk in the same way, I guess. But where you have a case where the insurer's not particularly keen, let's say, are there any sort of activities or processes or mitigations that could be put in place to improve the risk for an insurer who's not keen to make them keen and interested? Do you see any techniques being used?
Oh, yeah. And dialogue, first of all. The reason they're not keen, first of all, is often they haven't got sufficient information. It's what we touched on with the current COVID lockdown, is getting real-time information. So opening a dialogue, if you can get a customer buyer to open a dialogue, even not with you as a seller, but direct to an insurer to cut you out of the loop. We've got direct one-to-one discussions between insurers and buyer risks who don't publish information, but allowing under NDAs to share confidential information. So we absolutely encourage that sharing of confidential financial information to help a risk. That's probably the fundamental first, but there's alternatives. If you have to understand the reason for the insurer's lack of appetite, it may be that they have a capacity issue. It's not an appetite issue, it's a capacity issue. They've maxed their limit on that particular counterparty across their book or on that seller. So they've got a capacity issue, and we can often, and our industry does this quite a lot, look at top-up cover. It's a difficult one to play. If it's the top-up is needed simply because of lack of capacity, then, and it's a decent risk, then generally we can find some interest. If it's caused by the fact it is a difficult risk and the insurers are literally strongly restricting or refusing cover, then top-up is not so much available. We often get it where a credit insurer has cancelled cover or for future sales, and then we get an automatic pushback, can we get cover there? Well, the answer is almost certainly no, because if it's already cancelled, then there's an material adverse scenario.
Right. So I'm very conscious of time here as we wind down. Just one very quick last question is, you mentioned during your presentation, actually one of the values around credit insurance is the kind of almost on the minute information around a company's credit worthiness, rather than actually, looking at the publicly posted, financials, which could be 18 months old. Is that information and that analysis that insurers do, is that available as a service to risk managers, irrespective of whether they actually want the insurance?
Historically, it's not been. It's been part and parcel of the insurer's own due diligence assessment, and obviously a lot of the information is confidentially obtained and confidential to them. So in some cases, but in many cases, that information can be shared in an open dialogue, unless there is an NDA restriction. But as a separate contract without the insurance, one or two insurers have started to look at that. So effectively, you have a zero maximum liability policy, but with the credit underwriting service being offered. At least one insurer has been offering that.
So they're credit opinions in effect.
Yeah, you buy the credit opinion with obviously without any insurance backing.
Yeah, exactly. Well, that's a very interesting development. I'm sure to some of EMIC members and their firms might well be of interest.
Well, there's a huge effect, because getting credit information on customers is otherwise extremely difficult and can be quite expensive, and often with a Dun & Bradstreet kind of data can be well out of date.
Yeah, and you still have to analyze it.
Yeah.
But
to get a lot of the really good information on the higher risk companies, there needs to be some kind of relationship and trust and the ability to persuade or bring a buyer to the table to talk.
Great stuff. So we've got about a minute to go, so let's wrap things up now. I want to thank everybody for joining today, particularly to Rob and Richard for an excellent discussion, a great presentation, and the collateral that we have in terms of the recording and the slides. Don't forget to register 1 hour CPD for today's session. We used the full hour, so I wasn't particularly concerned that the presentation went quite quickly. Please, if everybody could just complete the survey as you leave, that would be really useful. And any after the event questions, you can see the contact details of the guys there. But I think it was a very timely and appropriate session. Really interesting, and thank you very much indeed. So with that, we'll say goodbye. Have a good day. Thanks, everybody.
Thank you. Goodbye.
Thank you very much. Bye-bye.